In today's episode, we are speaking to Ted Siedle. Now, I first heard about Ted through Robert Kiyosaki in the Rich Dad, Poor Dad YouTube channel and book series. Robert had Ted on, and it was the most incredible story I ever heard. You know, you're talking about one of the most successful, sought after attorneys, lawyers in the world that actually breaks corporate corruption and then now is focused on the fraud of the pension funds. What's happening in the entire pension market is totally fraudulent. That's the next big financial crisis headed our way. Now, Ted has actually investigated over 1 trillion, not 1 billion, in retirement plans. He actually has the largest ever US government award for $78 million, a whistleblower award for cracking a corporate fraud case. He's set his sights now on pensions. You can see in the corner right there, you can see that JP Morgan newsletter in the back corner hanging on the wall. And that's a $367 million JP Morgan Chase settlement charged the bank with failing to disclose all types of stuff to some of its wealth management clients. So this is a guy that's truly fighting the good fight. He has a fantastic book. It's called Who Stole My Pension? He wrote that with Robert Kiyosaki, has a new one out now that just came out pretty recently, which is called How to Steal Money Legally. Ted was named one of the 40 most influential people in the US pension debate for a few years running. And so this is going to be a fantastic episode. Please make sure you share this one. This is going to affect everyone, what's happening in the pension world. It was mind-blowing when I found out what was occurring. So please share this video, share it with a friend that's got a pension, and share this on social media. Make sure you hit the like button on this video. Send it out in the YouTube universe. Comment down below, Ted rules. Right there down below, we'll link his books. Shout out to our sponsor, Vizsla Silver, one of our favorite silver and gold mining stocks. So thank you, Vizsla Silver. Ted, that was a long introduction, but I think you deserve it.
Thank you. Thanks very much. One of the things I should mention, the two books, one was Who Stole My Pension, which I wrote with Robert Kiyosaki. And it's about how Wall Street has been looting America's pensions, and the pension money is just not going to be there in the future. The second book, which is How to Steal a Lot of Money Legally, is really about, again, how Wall Street steals a lot of money perfectly legally. So the two books are kind of connected. One is about pensions being looted, and the other one is teaching people how Wall Street steals, with the idea that if I teach you how Wall Street steals, it's less likely you'll get ripped off.
So it's pretty incredible, especially when I first heard your story. I read about what you were doing in the pension work. So give us an idea. So someone, you won a $78 million award. So you're doing big time. You've investigated over $1 trillion. I think you told me recently you just finished a $90 billion forensic investigation into the pensions. It looks like you're going to be placing a lawsuit against the Hollywood Actors and Writers Guild. So give us an idea of what's going on in this pension world. What brought such a big lawyer like you into that field? How are they stealing from us?
Well, we've got state and local pensions all over the country that I think there's trillions in these pensions, and they have promised retirement benefits to state and local workers all over the United States. And it's a well-known fact that these pensions are substantially underfunded. They've got basically, last I heard, they've got about 70 cents on the dollar, 70 cents for every dollar they've promised in retirement benefits. And with the baby boomers entering retirement, we have this huge demographic wave of people heading into retirement. They've been promised pension benefits for their lifetimes. And, people can easily live 30 years into retirement these days. Retired 50, 60, live to 90, 100 years old. So it's a huge problem related to aging, that you've got all these people headed towards retirement. The money has not been set aside. And what's happened is Wall Street has gone to these pensions and said, look, we can solve this problem for you. And Wall Street's solution to every problem, Wall Street's solution to every investor problem is pay us more in fees. That's always the rule. We can fix it. You just got to pay us more money. So what they've done is they've gotten the pensions to double down and make huge bets on what are called alternative investments. These are alternatives to publicly traded stocks and bonds. And we're talking about hedge funds, private equity funds, venture capital funds, real estate funds that are much, much riskier and have fees that are as much as 10% a year, 10% a year in fees. So lots of gambling going on with the goal that the solution to underfunding is wild gambling. And of course, you know what happens when people gamble wildly. They lose big. So the 70% funded will go to 20% funded over time. We already have some states like Kentucky where the pension is less than 20% funded. I just completed a forensic investigation of the Ohio Teachers Pension Fund, which is a $93 billion pension fund, and found all kinds of lack of transparency, excessive fees, excessive gambling. So it's a huge problem. The demographics create a huge problem. The underfunding creates a huge problem. But Wall Street is throwing gasoline on the fire.
So basically, it's just like a huge slush fund, similar to when they do all these bailouts and we find out all this money's going to whoever the politicians backs, whoever backs they need to rub. It's a similar type of thing. Basically, that's taking place, and that's what you're discovering is that this is a lot worse than they're thinking.
Yeah, and it's remarkable because American public pension funds are supposed to be the most transparent in the world. There are, most of your listeners are probably familiar with the Freedom of Information Act. Right. Freedom of Information Act applies to federal government. State government, state pensions, local pensions are governed by state public records laws.
Wow.
So all of these pensions, all this money, how its money is being invested is theoretically supposed to be fully transparent. There's supposed to be full accountability to the public. U.S. public pensions are the fundamental defining characteristic of them is transparency. But they have gotten, with conspiring with Wall Street, they have gotten very adept at evading the public records laws. So there's all this money that's being put into these funds that are recklessly gambling are being shrouded in secrecy. We don't know how the money is being invested from day to day and what the losses are, because Wall Street and these public fund officials have agreed that this information about these investments will be regarded as trade secrets, exempt from public scrutiny.
Wow.
Which is insane because the very documents we're talking about are what are called prospectuses, offering documents. These are documents that under the federal securities laws have to be made public. But when these documents are given to state pensions, the state pensions of Wall Street agree that they're top secret. They cannot be given to the public. So that's what's going on, is all this gambling is happening in secrecy. It's involving taxpayer money. It's involving pensioners' money, and there's no accountability to the public.
So the more you looked into this, I'm sure the more amazed you were at what was taking place. And I wonder, what do you believe now, really looking at this and how underwater many of them are? What is the consequences of this, especially when we're in a place where we're starting to finally see the inflation from all this money printing? We're basically turning a lot of America into a welfare state. There's already going to be so many promises that are needed. What are the consequences of what's taking place, and why does it affect someone who's listening to this right now?
Well, as I mentioned, some funds, like the state of Kentucky, are already less than like 20% funded. Means they have less than 20 cents on the dollar that
Wow.
they've promised. And these are statewide funds, not some small town that's running out of money like Detroit that went bankrupt. This is an entire state.
Wow.
And we've never had a state go bankrupt. Whether a state can go bankrupt under our law, who knows? We'll find out. But the point is that where you have secrecy, you know somebody has something to hide. There's no need for secrecy unless there's something to hide. So we know that, let's say these pensions are on average, supposedly 70% funded. Well, that's the best case scenario. The secrecy would suggest we're a lot worse off than that 70% funded. You know, if we were truly 70% funded and all was hunky-dory, there'd be no need for secrecy. But the secrecy allows people to misvalue, overvalue, overstate the value of assets, hard to value assets particularly. You know, so what we have here is a situation that is certain to be worse, and the fact that there is this culture of secrecy, which is new, by the way. This secrecy regarding America's public pensions didn't exist 15 years. No one ever made the argument that these investment contracts were secret in 1980 or 1990. This all began post 2000, and so it's clear that the problem is a lot worse than the public is being made aware, and the fact that there's this heavy cloak of secrecy really tells you something.
Does this end in massive state bailouts? I've heard Robert Kiyosaki say before that he thinks the COVID lockdowns and the money printing was just the warm-up act for the pension crisis. How does something like this end if they are that severely underfunded? And as you said, the demographics show us there's a lot of people that are relying on this money, and especially now they've been decimated by lockdowns. So does this end in a bunch of state bailouts, or what happens? I mean, how does this end?
Well, that was one of the big debates about the whole COVID relief issue in Washington was, would bailing out state and local governments be part of COVID relief? And that the Democrats wanted to have substantial bailouts of state and local governments, which code was bailing out pensions. That's because what is the biggest liability a state has? It's pension obligation. So when you're talking about bailing out a state or providing money to states and cities for bailouts, you're really talking about bailing out their pension system. So there was a wave of that in the legislation, the COVID relief legislation. But so yeah, COVID relief was cover for bailing out pensions somewhat, but it wasn't enough. There's going to be a need for more. Call it COVID relief. Call it pension relief.
So do they need to do new rounds of lockdowns in order to hide? Because it sounds like you're suggesting they want to try to hide from the fact this is happening. So whenever a crisis happens, whether intentional or not, do you think they're going to try to use it in order to push more money through? Because at some point you would think they're going to have to say, look, the pensions are totally underwater and this is a multi-trillion-dollar problem. Hey guys, we're not sure what to do.
No, I know you're wrong. So you just missed the point. They don't have to ever say that because of secrecy.
Well, what happens when everyone uses their money?
You're saying at some point we're going to have to admit the people running these pensions are going to have to admit the pot's empty. They don't. They can still, because of the secrecy that's come in, they can continue to say there's money there. At some point, they go to what's called pay as you go. So basically, workers are putting into the pension money for their retirement, and that money is going out the other door immediately to pay benefits of retired workers. So that's when you go from a true pension system to just a pay as you go system where the younger workers are paying in, and the money they're paying into the pension immediately goes out the other door to the older workers who retire.
So
But
you're saying that's what they'll move to instead of saying, hey, there's a problem. They'll just move to that model.
well, that'll be the next stage. Yeah, you first of all, whatever you do when you're trying to hide the problem, you've got to maintain secrecy. So secrecy has got to be maintained. You can't have someone come in and really independently determine how much money is in the pension. So you maintain secrecy. You go to a pay-as-you-go system when your money starts getting really low, and then you push it off, you delay. The thing about the pension crisis is it's a slow-moving train wreck. Pensions don't collapse overnight.
Right.
And one of the things I said, there's never been a pension that failed that didn't have a room full of experts saying it wouldn't. So they all have a room full of Wall Street experts saying it's doing great. But over 5,000 corporate pensions have been taken over by the federal government. You may have heard of the PBGC, the Pension Benefit Guaranty Corporation. So it is the federal agency that insures pensions, and thousands of pensions have failed and been taken over by the federal government. And that's why the PBGC is over $50 billion in deficit. And so there have been substantial corporate pension failures. There are going to be a lot more, and the problem is never addressed. You say the pension problems typically happen over a 30-year period of time. And so as long as if you can push it off, if you're a politician, if you can push off the problem for 10 years, you go with that solution, and the problem keeps getting delayed.
So the next thing I wonder is if they're moving to the pay-as-you-go model, but the United States GDP is in a free fall, robotics are replacing jobs, millennials are crushed by lockdowns. How is it that they transition out of that? Is there isn't enough money inflow to support how much outflow of monies is going to be needed for these pensions? What comes then?
Well, one of the things that you see happening already is the states that have the highest pension liabilities per population, like Illinois, Kentucky, and some of the Connecticut, some of the other northeastern states. People are fleeing those states, and they're going to states like Florida, where I live, that have low income tax or no income tax, and have healthy pensions. And the main reason the Florida pension system is healthy is because there's so many people coming into the state, not because they're any good at managing money. It's completely corruptly managed pension system, but there's enough money flowing into it that the fact that there's substantial leakage doesn't really hurt it. But so one of the things you're seeing is that certain states, certain cities, people are fleeing because the pension liabilities are mounting, tens of thousands of dollars per resident. Like one example would be the city of Providence, Rhode Island, where the pension liabilities are massive. And so this is a federal problem. It's a state problem. So leave the heavily indebted states, move to a state where the pension obligations are limited. So that's one strategy that you're seeing already. Certain states have negative population growth, and that's a short-term strategy. But ultimately, those states are part of the United States, and the money's going to come from somewhere. And if it's not coming from within that state, it's going to come from outside the state.
So does it end? Do you believe that one day it will end with a massive federal bailout for pensions?
Well, again, it's a slow-moving train wreck. So there's not a massive bailout today or tomorrow. It's an incremental bailout, most likely. And we already have it. Like I said, the PBGC is $53 billion in debt. They didn't get $53 billion in debt overnight. The agency has been in operation for, probably 50 years or so, since the 70s would be my guess. So that debt has accumulated over time. Most Americans aren't even aware it exists, that $50 billion
Right.
in debt. According to the PBGC, and corporate America would tell you that this federal guarantee of corporate pensions is funded by the corporations through fees. That's simply not true. Otherwise, we wouldn't have a $53 billion debt. So there are fees that the corporations pay to the PBGC that contribute to the PBGC's overall budget, but by far do not pay for all of the failures. So it's a slow moving process, and no one's going to deal with the problem in one fell swoop. So it'll be a series of incremental bailouts, fashioned, call it COVID relief, call it whatever.
So Ted, I can't imagine you're the most liked guy by a lot of financial corporations, Wall Street, and some of the bigwigs in the politician world. You seem to be sticking your nose maybe in a place that they don't really want your nose to be.
Well, it's funny you should say that, because as a result of Who Stole My Pension, the book, 38,000 school teachers in the state of Ohio did a crowdfunding fundraising.
Wow, that's amazing.
And they raised $75,000 to hire me to take a look at their pension. And some people will say, well, Ted, you made a lot of money. You don't need the $75,000. And I said, well, my theory is that I want these people to vote that they really want to see this done. And I don't want anybody to contribute more than a couple of dollars. So this is $75,000 raised by 38,000 people. Nobody had to pay a lot of money, but that's a vote. They're voting with their dollars. So you say a lot of people don't like me. Well, I can tell you 38,000 people like me a lot for the work I've done there. And I've done this in other states. In North Carolina, 55,000 State Employees Association of North Carolina. They're the largest union in the South, 55,000 government workers. They raised a similar amount of money a few years ago. And in Rhode Island, there were 3 crowdfunding investigations of the Rhode Island pension system, again, paid for by individuals, workers, and some of the local labor organizations chipped in as well. But so I tell you that, and of course, I write for Forbes as well, and I get millions of readers a year. So I have a substantial following among people on Wall Street who know that the game is rigged and people aren't being told the truth, and among workers and taxpayers who want to hear the truth. So have a lot of following. So I would tell you the people who don't like me are a small minority, because since I am the only person who does this work, the only expert in money management who does forensic investigations of pensions, I'm pretty well liked by those people who hire me. Because
right. Well, you're fighting.
The only one who does it.
You're fighting the good fight. Any of these small minority forces ever try to ruffle your feathers or anything?
Oh, all the time. Yeah, all the time. And
death threats?
Well, one of the things that is funny is that I've done over $1 trillion in forensic investigations, and many of them, the investigations I've done, are publicly available. They're typically 100-page reports. If you go on the internet, you type in my name in Rhode Island or pension or Ohio pension, you'll find these investigations. I also have a website that is Siedle Whistleblower Forensics, where 8 or 10 of these investigations are online. The findings come out, and one of the things that surprises me is people say they're surprised that the target of my investigation didn't agree with my findings. Well, they never agreed with my findings. You think JP Morgan agreed with my findings when I got paid $78 million? Of course not. So every time I do a report, the target says I'm wrong. I don't know what I'm talking about or whatever. But if you do it long enough, you have a successful track record, that criticism gets muted over time. But
any death threats or anything like that? I mean, you're talking about some of these are not the best people in the world at the tops of some of these types of things like that.
Sometimes it can get pretty nasty, but one of my rules is that, to quote Dolly Parton, I don't go after anybody who ain't worth killing. So you want to stay away from the small money manager who's got nothing to lose. The JP Morgans of the world don't make death threats, at least not to me. And the big financial corporations don't, and they're not desperate. But if you go after a rogue player who, when you expose them, is going to lose everything, those are the kind of people you have to watch out for. And those are the people that early on in my career I would occasionally cross swords with, but these days I won't go anywhere near them because they're dangerous and there is no upside. Because when you expose them, they essentially go bankrupt. You don't get any recovery, and so those are people I typically stay away from.
Makes sense. So, how did you get hooked up with Kiyosaki and read a Rich Dad Poor Dad series book you guys wrote? Your book was Who Stole My Pension? It's right over there on, if you can see it as a viewer, on the table right there. It's a great book. How did that all come about? Because you've been doing your work kind of, I wouldn't say in the dark, like you said. There's a big movement of people that want to see it out there, but I had never heard of you until you did your book with Robert. So how'd that come about?
Yeah, one of the curious things about my work is I have two types of work. One is extremely high profile, like in Ohio, where I'm doing it from the get-go. The fact that I've been hired, my work product, everything is public, and it gets a lot of media attention, whether it's on the New York Times, Wall Street Journal. And that work, ironically, is the work that pays me very little. The work I do that's secretive is where I make my real money. And and enables me to do the other public work for basically pro bono. So yes, I have the investigative work I've done is highly secretive. Whistleblower work that's protected by government confidentiality provisions, and that work is with the SEC, the Commodities Futures Trading Corporation, the Department of Justice, the FBI, and even sometimes the intelligence community. But that's the secretive work that pays the bills that nobody knows about, and then there's the public work that people know a lot about, but hardly pays the bills at all. But what happened was Robert heard about the whistleblower award and about my work in pensions, and he had a group leaving for a cruise out of Fort Lauderdale a couple of years ago, one of his seminars, I believe. And he called me and he said, I've got 600 people at the hotel. Can you come in and give a talk one evening? And before we leave, following morning, we were leaving, for a week on the cruise. I said, sure. So I just, threw on a baseball hat, ran down to Fort Lauderdale. Is only half an hour from my house. And I walked in the room. He handed me a microphone. It was like on Oprah. You just walk around the room and answer people's questions. And one of the things that he and I were both surprised about is that everybody has a view on pensions. It's not just the people who have pensions, but everybody's got a view. If you've got a pension, you want to know about it. You have a keen interest in it. If you're a taxpayer, you have a keen interest because you're paying into it, and you're always hearing that there's a big bill coming down the road. So what we found was that everybody in the room had a question that they wanted answered about pensions. And so coming out of that conference or seminar, and the room was a huge room. It was a banquet room with, there was 600 people in the room. um, uh, coming out of that, we realized that there would be a lot of interest in pensions, and so I actually wrote my part of the book in 90 days. I've never done anything that quickly. It came together very quickly for me, and so we got it out. I think within 6 months of that initial meeting in Fort Lauderdale.
So what's some of the nastiest stuff you've seen when you're doing some of these forensic investigations? I know you said some of your work is surrounded by confidentiality, but what's just to give, you know, us that aren't peeking in on the scenes, give us an idea of some of the nasty stuff that's going on with it.
Well, when we talk about pensions, I bring up this concept called gross malpractice, generally practice. The fact is that most pensions around the world, or all over the world, whether it's, and we talk, by the way, in Who Stole My Pension, we talk about Japan and other countries that are only beginning to make the mistakes American pensions have made. Because you have to understand, America is the world's premier financial innovator. We make the toxic shit that we sell to the rest of the world. All of these, complex mortgage-backed securities, CMOs, derivatives, they're all created, they're made in America, they're toxic assets made in America that eventually get sold overseas. And so a lot of the highest risk investments like hedge funds and private equity funds were initially sold here in the US about 15, 20 years ago to pensions as a solution to fix their underfunding. Now, 15 years later, they're being sold in Japan, Australia, and Germany for the first time. And what are they telling those investors in Germany and Australia? This stuff worked great in the US. So we're offering you the same opportunities that we've offered American pensions. It's worked out so great. Well, of course, they haven't worked out great in America. And so these same toxic investments are being sold abroad. So one of the things I tell people is all pensions are grossly mismanaged. And I call it gross malpractice, generally practice. It's the rule, not the exception to the rule. And so for once you understand gross malpractice, general practice, and then when we talk about specific types of pensions, in the US, public pensions, state and local pensions, are run by laymen. The people overseeing these pensions are cops, firefighters, school teachers, sanitation workers, government office workers. These are the people on the boards making decisions on how trillions of dollars are being invested. So a Wall Street guy comes in his crocodile loafers, $1,000 crocodile loafers, and he's pitching investments to kindergarten teachers. That's what they do for their full-time job. And some of them are great friends of mine. They're wonderful people. But as one of them said to me, he said, Ted, I don't know the difference between a stock and a bond, and I'm running a $14 billion pension fund. I said, Jack, I know you don't. But fortunately, you know me, and I'll give you some hints along the way. But so we have a system where the people overseeing our state and local government pensions are laymen. They're school teachers, firefighters, cops, and they are negotiating with Wall Street's finest, the best and brightest from Wall Street, selling the highest risk, costliest investments known to man. So it's an unfair fight to begin with. And then once you understand that the boards of these pensions are, completely incapable of making investment decisions, then some of the other things that I point out is that all pensions lie about their investment performance. And the reason they do is because nobody wants to announce that they're the worst. So every pension finds a way, with the help of Wall Street helpers, to be able to tell the world they're a top performer. Well, they can't all be top performers, but you will never find a pension. In 35 years, I've never seen a pension that comes out and says, we're the worst. we're really bad. We suck. Doesn't happen. They all claim to be great. They all lie about the fees they pay. Every pension in the world lies about the fees they pay. I went into Rhode Island, and the state of Rhode Island pension said that the fees they paid were $10 million a year. I said, that can't be right. So I went through, and within 3 months, I showed them that the fees were actually $80 million.
Wow.
8 times greater. And to this day, the state of Rhode Island Pension Fund now discloses its fees of $80 to $90 million.
Oh.
Only because I challenged them publicly, and they made it. So they all lie about, all these pensions have boards that are in them. They all lie about the fees they pay. They all lie about the risks they take. Again, that's where the secrecy comes in. They're not going to tell the public that they're taking wild bets, so they do it in secret. And they all lie about their performance results. So it's it's a pretty ugly road where this is what is common practice for all these pensions.
So you've got to be walking with your $1,000 crocodile shoes. You know you're shooting goldfish in a bucket, and you know you're ripping them off. You know you're stealing all this money. I mean, you've got to be one of the dirtiest bastards in the world. And I just wonder, how on earth do you even? How do these people It's amazing. How do you live with yourself?
Well, I've known a lot of money management marketers in my life, and many of them, I'd say half of them, will sarcastically, humorously tell you that they're selling garbage. But the other half are true believers. They don't see it that way. Well, you can make a lot of investments, and is my investment the best in the world? Well, maybe not, but it's also a lot better than others. So I'm saving you from the really bad investments, but am I offering you the best investment known to man? No, of course not. And the truth be known is that half of the people, 90% of all money managers on Wall Street cannot be an index fund. So they shouldn't be in business at all. They're incompetent at adding value. So what you find is that there's a callousness that develops over time. Those 90% of the money management industry is not going to simply quit its job and go home. Okay, this is not going to happen. And so one way or another, they rationalize that what they're doing is good for the world, and that they're worth the exceptionally high fees they charge.
So many people that follow this channel, we talk a lot about gold and silver. JP Morgan's been fined all sorts of money for what's called spoofing the metals market. So they're not well received in the precious metals community. Now, you actually won I think it was $378 million, some fraud stuff they were doing. You were awarded personally $78 million out of that case. How did it feel to walk out of the court that day knowing you were getting a $78 million check because you caught one of the dirtiest organizations in the world red-handed?
Well, nothing happens overnight. So it's not like you walk out, that it's like there's a series of the government recommends that you get 28% of the $370 million. Then you go, hooray. It's like, great, celebrate, break out the champagne. But then that has to be approved by the full commission. So then you wait on that full commission, break out the champagne again. That's, 6 months later. Then there's an appeal process. Anybody who feels they've been shortchanged, any other whistleblower out there can file an appeal. And in my case, they did. But they dropped it. So then, you're looking at another couple of years to get paid. But then the person who filed the appeal dropped it. And then there's a call. And then you wait, then you're finally been awarded the money, but you've got to wait months to actually have it hit your account. And even that, let me tell you, the wire doesn't go through the first time or the second time or the third time. So even the day all the contingencies have been eliminated, the money's supposed to be in your account, it still doesn't arrive. It takes maybe another week. And of course, the bank is going, what is this money? Could this be drug laundering? And you have to sign all these things. No, believe it or not, it cannot be drug laundering. It's coming for crime solving, okay, from the feds, okay. But so anyhow, it's a long process, and there are a series of congratulatory moments. But by the time you actually get the money, you're just exhausted.
So I'm infatuated with building FU money. I don't like the government. I don't trust the government, and I think that we're headed for a lot more unstable times than people believe. And so I'm 29 years old. I turn 30 next week, and we talk a lot about investing in commodities, macroeconomics, similar type of channel as Kiyosaki. But I also always like to, when I have someone really successful, such as yourself, I like to kind of, pick your brain a little bit to help whomever is listening to take that next step in their FU money. And the reason I use that term is because when you and I were talking on the phone yesterday, you had a friend, won't disclose his name, that was going to write the foreword, but then he said he couldn't write the foreword to your book because he didn't have FU money like you. In one instance, you got a $78 million wire. You're a top level lawyer fighting the good fight. So how does someone build FU money? What do we even do when we want to get started?
Well, I mean, basically, I tell you, you need to develop a plan of some sort, and you need to, avoid a lot of the Wall Street advice that you're given, because, clearly the people giving that advice, it's not working out for a lot of people. If you look at one of the things I talk about in How to Steal a Lot of Money Legally, this book, is about how the 401k system has completely failed to provide retirement security to workers. So, 401ks were supposed to replace pensions and provide retirement security to workers. But in fact, they have dismally failed. Your average 65-year-old has less than $100,000 saved in a 401k, well less than 100,000. And when you see these figures on the average 401k, you have to keep in mind that many workers don't have a 401k at all. So the averages that's for people who have a 401k. But if you figure out, what does your average 65-year-old have in a 401k? Well, if half of them don't have a 401k at all, you got to cut the number in half right there. But so anyhow, the 401k system has failed dismally. Wall Street's solution to retirement security is not going to provide for you. So you need to develop a plan. And I wouldn't tell you what your plan should be based upon. It has to be based upon your unique knowledge set, skills. But I could better tell you what to avoid along the way. And what I like about Robert's message and your message is that people should, come up with a plan of their own and not rely heavily on Wall Street advice and Wall Street products, if you will. So whatever, I can tell you that the whistleblower business has only existed for the last, since Dodd-Frank, since 2010. It's really only been, the whistleblower program has really only been in operation for less than 10 years. So this is an industry, a cottage industry, if you will, that I'm involved with, that didn't even exist 10 years ago. So when I started doing this forensic work in the 80s, there was no opportunity to get a whistleblower award. So it's just an example of, I think, some professors that said that, to his students, the jobs that you'll be filling in the years to come don't even exist today. And I think that's what you have to look for, those opportunities that are that you see from your unique perspective that maybe not even exist today. And beware of a lot of this, gross malpractice, generally practiced, general investment advice that just has failed, doesn't work out well for people at all.
So we'll do a part 2 and we'll really break down the how to steal money legally. But give us a quick couple breakdowns on some of those main things to avoid. You said, everyone's going to have their own unique plans, but there are some universal things that we really need to avoid that are, mass marketed or the majority of people are following. What are a couple of those ones that you kind of break down there in the How to Steal a Lot of Money Legally book?
Yeah, well, How to Steal a Lot of Money is in a thumbnail. Let me just tell you, the idea behind the book is a financial literacy program that is premised on the belief that by teaching you how to steal, I'm actually doing you a tremendous service. The best investment advice I can give you is to teach you how Wall Street, the best thieves in the world, do it perfectly legal. And so that's the approach. And I think it's a little more compelling, a little more engaging than a book on what is the difference between a stock and a bond, what is a mutual fund, et cetera. So it's really, I would call it a bit of a subversive approach to teaching financial literacy. But I think it's more engaging, particularly to younger people, than an old-fashioned textbook on finance. But some of the culprits that I call out in the book are, retail mutual funds, which are, high cost, but poor performing, and typically what you find in 401k menus. And so the other thing I talk a lot about in my work is avoiding conflicts of interest, avoiding excessive fees. These are things that in my book, I point out that most investors don't care about the fees they pay, don't know the fees they pay, and they aren't even aware of what the fees are. And if you ask them, they say they don't really care. All I care about is how much money I'm making, not the fees I'm paying. Well, the money you make is net of the fees you pay. So you have to know what the fees are. It's important to know what they are. And fees are the only thing you can control. You can't control the investment results, but you can't control the fees you pay. So it's important to focus on fees, look at fees. And what I tell scammers, my advice to scammers in the book is that most investors don't care about the fees they pay. So charge them up the wazoo and they won't care. And that's the truth. And you'll see that in the pensions space, that pensions today are paying more in fees than they paid 30 years ago, and they don't care. It's acceptable. So those are some of the tenets of my work are avoiding conflicts of interest, avoiding secrecy. You always want transparency, avoiding excessive fees, and a lot of the products that you see being pushed on Wall Street have those flaws.
So let's talk about something that someone can do. I don't have a pension or a 401k. I, own my own businesses, and when I kind of broke down the math, it seemed to make more sense to, at least when we're talking stocks, to just use a normal brokerage account. And so I never really noticed how insane it was, other than just reading your books, but I didn't think about it that much for me because I didn't have one. And so my sister-in-law works for a state facility that has your 401ks, and they offer a percentage of a match. And, I invest in natural resources, commodities, mining stocks. And, I've done pretty well, and I've done pretty well for my mother-in-law. So my sister-in-law wanted some help. So I logged into it, and she only has 5 things she can pick from. I was like, I didn't even realize that existed. And so then I started thinking to myself, so how do I help her? What does someone do in an instance like that when they find out they have a lot of money through a company, through a pension, through a 401k, invested in something with high fees that's a bullcrap product? Should they self-direct? What do you do in a position like that where you kind of wake up after listening to someone like you and you say, well, what should I do with my wife's pension or my wife's 401k or my mom's or my own, what do you advise?
Well, the history of 401ks are that the 401ks were started in the 70s, and they grew in popularity and eventually replacing pensions. And all along the way, it was assumed by regulators that having the same high-cost retail mutual funds in a 401k as an ordinary investor would buy in his brokerage account was fine. That these retirement accounts didn't get special treatment. They didn't have to offer particularly good product. Well, and starting around 2006, 2007, a lawyer, a friend of mine, Jerry Schlichter, brought a series of cases against the leading 401ks in the country, challenging this assumption that the people running 401k retirement plans could still just pick high-cost funds. They didn't have a fiduciary duty, a legal duty, to pick the best, lowest cost funds for these special accounts called retirement accounts. And those cases were highly successful. These were cases brought against Northrop Grumman, Caterpillar, Edison, John Deere, Walmart. All these cases challenged the idea that offering crappy, high-cost retail mutual funds in a 401k was good enough. And now it's not good enough. It's pretty clear. Case after case has been won. These are called excessive 401k fee cases. So now, if you have, like your sister-in-law, if hopefully, I would think she would have at least one index fund in the offering. If not, that's a company that's probably going to get sued. But if my first piece of advice would be, if there is a low-cost alternative in the mix, I would go with the index fund for sure, and stay away from the actively managed retail type funds. So that's the key piece of advice there. And as you say, one of the problems with the 401ks is the employer gets to pick the menu, what we call the menu, the investment menu. So if the employer does a particularly crappy job, then the employee just has, to choose the least bad alternative. And then there are brokerage windows, whatever, that you can explore. But at the outset, I would look for the lowest cost index fund offered. And if it really is a bunch of high cost stuff, then I would see if I could use the self-directed brokerage window to get into other products that are better.
Okay, good to know. So for anyone listening that would like some specific things to address, we'd love to have Ted back on after I read his new book, which should be here in the mail tomorrow. I'm going to link that right there down below. That's How to Steal Money Legally. We'll link that right there down below. If there's any important questions, maybe you have a pension, 401k, what have you, that you'd like to see addressed, you can leave those right there down below, and we'll be sure to source them for the next episode. Ted, you're kind of like it's pretty cool to see, over and over and over again, we see the average person getting screwed over, and it just seems like there's no end to it. And it's not just screwed over in isolation. I mean, we've got this financial system, this money printing, how much longer till the wheels fall off? Who knows? And it's nice to see someone like yourself that's stepping up to the plate. You said there's not a lot of people doing what you're doing specifically for pensions, 401ks. I mean, we're talking about people's livelihoods, and not in isolation, right? Because this is a domino that affects the entire country of America ultimately. So I want to thank you for what you're doing, and thank you for coming on.
Well, thanks very much. I think that, these days, with the demise of pensions and with the proliferation of financial products, and with the rise of 401ks, basically the entire burden of making investment decisions, financial planning, retirement security has been shifted onto the individual. And it's complicated as hell. The idea that every individual can be an astute portfolio manager, that's a pretty bold assumption. So Americans really need to focus on financial literacy because it's more complex than ever before, and the consequences are more dire than ever as well.
Thanks so much for your time today, Ted. We're going to link his book right there down below. If you'd like to see us do a part 2 breaking down the book, give us a comment right there down below. We'll link the book. We'll link Ted's law office website right there down below as well. Make sure you hit the like button on this video. Send it out in the YouTube universe so more people see it. Share this. Maybe you got a friend with a pension, 401k. This is an important video to watch through. So be sure you share it on social media. Send it out to a friend. Help spread this word and help spread this message. And Ted, any final words?
Nope, not really. Sorry. Again, I just tell you, spend some time cultivating financial literacy, because it's a very dangerous universe right now. There's a lot of scamming going on and a lot of challenges to the global financial system. And so more than ever, I would encourage people to spend some time learning about investing, because if you don't, you'll pay the price.
So thanks for listening to today's episode. We will see you next time.